This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless A Trading Frank. It's approximately 8:27 p.m. on April 28, 2019. This is a Clueless A Trading strategic webinar. Session will be recorded, uploaded to the Google YouTube channel for viewing by all members and anyone out there with the internet connection. They can always access and spread the word around. They can always access Google YouTube, type in Clueless A Trading, listen to these fantastic forecasts, which have been accurate, I would say 70 to 80% of the time overall. In fact, on the longer term charts, we are right almost 90 to 100% of the time. On the short term forecast, I would say our performance ratio is around 80%. So 8 out of 10 times we've been dead right on what's going to happen in the near term, which, by the way, just to remind everyone, forecasting is a very, very difficult business given the volatility in the market, given all the news flow, given everything that's going on. And despite all that, Clueless A Trading has delivered. Like to always remind people that if they want to keep in touch with the market on a closer basis, they need to track and trade and follow the real-time Twitter feed, which basically maps out the market on an intraday basis and an intra-week basis specifically for traders, because that's really what it's all about. In the meantime, full disclosure, this is purely for financial education, not for any solicitation or advice. And we shall begin. We have two great members. We have Mike. I think he's fixing his microphone right now as we speak.
Hello?
Yes, Mike, are you there, sir?
Yeah, can you hear me?
I can hear you loud and clear. Just if you can, just mute your mic a little bit using the mute function at the bottom of your screen on the right-hand corner so that we don't get any feedback, but I can certainly hear you, sir. So,
okay, how is that?
No, that's completely fine. It's just that we get a lot of feedback, when we speak. This is fine. Just keep it that way. If there's any issues, I'll mention it to you. I'm glad you're connected. We also have the other Mike, my great friend here, Mike from Wisconsin, and Mike, you are connected, correct? Mike H.
Yes.
Yes.
I also talked to your friend JB today.
Oh, yes. I keep in touch with him quite a bit. He's one of my good friends, and that's the reason, he referred you, and I'm very, very happy about that. Great people. Thank you. So, okay. On that note, let us begin. We want to keep this to the point and keep my blabbering to a minimum. So let's start off by looking at the longer term picture, or what is the bigger picture of what is happening with the market. This is a live screen that you're looking at of the E-mini futures. Markets have started trading. Very important note, Japan is on a 10-day holiday. 10-day holiday. Not exactly sure what it commemorates, but Japan's on a 10-day holiday. So that means that the overall Globex, that's the global overnight session on the Nikkei futures, is going to be non-existent because the Japanese markets are closed for the next 10 days. Okay. So saying all that, futures are up roughly about half a point, quarter of a point, and you're seeing that right here at this corner. Let's zoom out and see what's going on here. And I'm going to try to keep this as simple as possible. So here we are off the actual market, the S&P 500, and you can see here very clearly that with all the technical formations and everything going on, this is where we are. I'm going to remove a couple of lines here so you all can see what we do, which is as a strict discipline, follow the chart, mix in the fundamental analysis of what's going on, and hit the targets as well as we do. And I do continue promise that I will keep on working very hard to deliver the results, and more importantly, deliver the forecast so that others can manage their trades and have a notion of what the market is doing. So this is the corner we're at right now, and I am choosing a different pen color so people can see that this is the corner we're in right now, in the month of April. And as you can see here very clearly, that this is, again, from a technical pattern standpoint, a ongoing bull flag. This is an ongoing bull flag right there. You can see that. Now, a bull flag can look like this. This is a consolidation bull flag, like an F, like a franc. Markets can move like this, which it has many, many times, then break out. Then we have bull flags like this, which are obviously from a degree of probability better because they're sloping, angling higher, right? Then we can even have bull flags like these, which we call consolidation, slightly tilted F formation. There we go. These are all patterns of bull flags. What is not a bull flag is something like this, where it is sloping below the 50% mark, of a big move higher. So when markets move higher on a sharp level, let's say over a 24 to 48 hour basis, then it gives back as profit takers come in, and we lose 50% of that move. This is very important stuff. And that's the reason why we use the Fibonacci retracements, as you know, and we're going to take a look at that again as I keep on posting all through the day. And as we know, the Fib 50 or the Fibonacci 50 level, or giving back half of a major move on the market, is something that acts as a very solid support. In bull markets on a primary trend going higher, the 50% Fibonacci 50%, or giving back half of the gains, is and acting as major support where you can re-enter that trade, is something that happens quite often. And that is exactly what's been happening on the overall markets, and it happens with stocks too, but we're talking about the overall markets here very often. And we're going to look at that. So remember what we're talking about here. So when we look at the Fib 50 on my S&P E-mini charts, futures charts, you will see that's exactly what's been going on. So we are poking our nose. The market, as you know, I had to run out for a very important family appointment on Friday at around 3:30. And I noticed, of course, we are all technologically connected on my iPhone, on my large screen iPhones, that we actually broke out. The market, what we call in the old days in Wall Street, painted the tape. In other words, closed above the mark should have closed at, which for the S&P 500 was 29.34, and on the E-minis we closed above 29.38. You can see that right there, and this is where we are. So we're poking our nose here on the longer term charts, and the best way that I can determine that on a short term basis where we can go is this line. These two lines, these are known as we all know by now, and many of you who are not that well versed on technical analysis, very important. This is a rising wedge. A rising wedge as we get narrower and narrower as the market climbs higher. So this rising wedge here, these two lines, as you can see, basically bring it up to one second. This is the rising wedge, actually. This is one. Bear with me one second. Right there. This is, I should put this different color. That color would be this. There you go. That rising wedge brings us to 2960. So we're talking about another roughly 20 points from here to here, which translates when it comes to the Dow Jones Industrial Average of another maybe 100 to 120 points on the Dow Jones Industrial Average before we hit a real roadblock. Now remember one thing here. These real roadblocks can go higher. When I'm giving you the bullish standpoint here, and then of course I'm going to show you what the bearish picture can be, i.e. the negative picture can be. But at this point, what we have done And I'm setting this up for you guys. There we go. This was the intraday high or the pre-market high on the market on September 21st, 2018, right there, right there. You guys are all seeing this on the screen, correct? Mike and Mike?
Yes.
Exactly. So right there, that was a high generated. I'm trying to look for the time. It just gives me the date. Hold on one second. This was probably pre-market or intraday, not quite sure, but that's the point, and I will tell you what it is. There we go. So it is approximately at around 29.47. That's about 5 handles or 5 points higher from where we are right now on the futures. So 5 points times 7, that's about 35 to 50 points higher on the Dow. Most probably that's where we're going to open up. Now, as a trader, very important to keep in mind that when the market gaps open 5, 10 S&P points and opens up 60, 70 points, and you have some trades put in place, as we have from Friday, you need to basically take some profits off the table. I always say full or partial profits. In other words, you can sell the full amount of your holdings. Doesn't matter how many contracts of the S&P 500 or SPYs that you have, or you can sell a partial amount. What I generally do is I sell the whole thing. I look for a entry point within the first hour or two of the market opening up, and then as you know, then the market decides what it wants to do by mid-afternoon to late afternoon. So that's the way I do it. Now, is it always correct? No, because sometimes the market pulls back for the first 15, 20 minutes, then turns around and starts to move higher. That's the reason why, as traders, we're flexible, and you have to follow the real-time Twitter feed, which is a real-time map of what is going on. But that's the general rule of the thumb that I follow, because profits are profits. You want to bag it in the morning, feel great about it, and then use part of that to re-enter and make some money during the day, or set it up for the following day or two. So that's where we are. But what I wanted to talk about very quickly on this particular chart, that when you look at this chart here, you can clearly see that here, this is another bullish formation, which shows that we can go as high as 29.80. Wow, that's another 200 to 250 points. You follow this line right there. Follow that line. That's a rising wedge. So yeah, we can go as high as 29.80. So anyway, bottom line is that, remove this line. Oops, did I remove that completely? Hold on. Bottom line is that we are on an uptrend. That's really what this whole picture is showing. Hold on. Technical analysis is all about, if somebody wants to tool around with it, which they should. It's kind of fun doing that. There we are. That's 29.68. Is you just have to join the lines and make sure that you have points of contact in, at least 3 major points of contact, if not 2, which will give you an accurate idea of what the chart is telling you. So this point of contact would be one here, where the markets broke down. That was back in December, the last leg of the big breakdown, the Christmas Eve massacre. That's what we call it, which we ended on Christmas Eve. So I touched that point here, right there. Touch this, and that brings us up here. So that's how it works. This is a rising wedge. Okay, so we're good with that, gentlemen.
Yes.
Okay, sounds good. Now, one of the things I like to remind people that I use basic the basic tenets or rules of standard. Mike, you might want to mute your microphone if you can. getting a lot of feedback? You can still hear
Okay.
me? Yeah, if you can,
Yes.
yeah. If you can, that's not a problem, sir. So bottom line is that I use the basic, and this is why the advanced coaching sessions are so critical for people who are newer to technical analysis, which is the basis of managing your trades better and not getting out at the wrong times or not buying at the wrong times and selling at the wrong times. That's why I always, encourage people to for the advanced coaching sessions, and certainly sign up on that on the website. You can go on the top members, what's it called, members area, and then just click it. Sign up for the 5-pack session. So it's not just a marketing pitch, but it's something that you certainly help you a lot. The key with the technical part is that this is that these lines that when I draw and I use the basic fundamental rules of technical analysis, and after that I add my own. Not I don't reinvent patterns, but I look for points of major supply and demand, which is where the markets broke down. I use my own thought process of the overall feeling on the markets, as you know I do every day, and then I get to that forecast. And if people focus on that forecast, you will see that, like I said, at least 70 to 80, if not more percent of the time, and in the longer term forecast, almost 100% of the time. I know that's a very boastful statement to make, but it's a fact that the market gets there. In between, it creates massive volatility intraday, lots of chop, as they say in the business, back and forth, 50 points down, 100 points down, news flow coming out here and there, which we have to basically not disregard, but we have to keep an eye, focus on that. But it gets there. And so, in my opinion, it'll get there. The market is going to break away and get there. And by that time, I think a bunch of people who've been sitting around will feel good. But at that point, the bad news is that we would probably be selling hard and going into a short position, i.e., shorting the market on a limited time basis, i.e., the market's going to pull back quite a few hundred points from these levels. And that's exactly pretty much, I think, what's going to happen. So, saying all that, that's your bigger picture on the market. We still have room to move higher. And we have the China-US trade negotiations in full blast. I know President Trump, I think he's announced that he might be meeting the Chinese premier sometime by the end of the month, but sometime by the first week, 5 to 8 business days of May, we will have a forceful move higher in between the intraday volatility, and then the market's going to pull back. And then we might end May on a good note as after the consolidation. We'll see what happens on that. So just be prepared for that on a broader basis on what will happen in the market. Okay, but the first couple of days of May, which will kick off on the first, which is Wednesday. So if we do a day count, 1, 2, 3, 4, 5, 6, 7, 8. By May 10th, and I'm going to write this down right here on the screen. By May 10th, 1 second. May 10th or thereabouts, give or take it, plus minus 2 or 3 days, May 10th should be, in my opinion, a intermediate short-term peak on the market. After that, the market will consolidate and then decide what it needs to do. Overall conditions are very good. I do not expect a 2,000-3,000 point type of move down unless that U.S.-China trade negotiations and everything that the Trump administration's done to further that cause is completely falls apart. In that case, the market will fall in excess of 1,000 points. But aside from that, I'm expecting this May 10th, around that period, to be a short-term major tradable peak. What does that mean? That simply means that we are going to be less long biased, aside from certain individual stocks which will follow their own routine. We will most probably be looking at some swing, which means a couple of days shorts on the market in the form of SPY, QQQ, IWM, DIA. Those are the major indices that we trade on the up and down. So You both with me so far?
Yes.
Good. Now, keep in mind that these things can change quite dramatically. That's part of trading. It could be before May 10th, but technically, this is what the charts are showing. So that's it. Now, looking at the bigger picture, we saw that. This is your chart of the S&P 500 from what I posted on the on the on my Twitter feed. You can see here, this was before I left on Friday, I believe. This is where we're going up, and this is certainly bullish. You can see that. Now remember, these were 3 days of like back and forth red candles, and but it didn't matter because it was still a bull flag. Remember how I explained the bull flag earlier on? A bull. This is, if you look at it this way, that's a bull flag. That's a bull flag. There you go, breakout. That's a bull flag. Big consolidation. That was quite a few hundred points. Still went higher. The primary trend within the context of these two blue lines, which is the rising wedge, is still intact. Remember, I don't just make up things and say, oh, the market uptrend is intact. That I have to have a validation on the technical side and the fundamental basis on what is happening in the background to make a determination on that. But purely from a technical basis, you can see what's going on. Now, we had some danger here after those 3 days, earlier part of last week, that we could have pulled back a little bit more, but we didn't. So we have to respect that. We have to respect that. So let's look at the shorter term charts, including the Fibonacci retracements, which I talk about. And this is the S&P, this is the QQQ, which is the NASDAQ, which includes the big names on the tech side, gentlemen, and of course the biotech side. This is your 1 hour chart that you can trade on an intraday basis, or if you want to look at it more from a swing basis, this is what it looks like. I will tell you that this chart is on a significant breakout for obvious reasons. Look at the tech stocks. Even with Amazon pulling back after hours, the stock was up a lot on Friday. Okay? So the bottom line is, when you look at it, this was the high. This was a double top. That's a double top right there. 1, 2, right before the fallout in October. That's the past. We got to always look at the future. That's the old saying in life, right? In business, you cannot drive forward by looking at the rear view mirror. You keep an eye on the rear view mirror to see if something's like coming really fast at you. Those are the algorithmic high frequency trading programs, but you need to keep your majority of your focus on what is in front of you, not behind you. You got to look forward, and you got to look forward, and that's how we do it. Okay, and you can see here, this was the double top. It broke out over that at 187. We are long the QQQs. We are long the 190. I think the 191s, 190s. You can even go higher because the Qs on a projected basis, swing projected basis, not in 1 day, but in maybe a week or so or more, we could hit 195. If Apple delivers numbers, this is a big week coming up for numbers. Two major companies we got to keep in mind on the tech side. Google on Tuesday or Monday after the close. I'm checking. Yeah, Monday after the close. And Apple, I believe, on Thursday. Okay? Those two major components of the QQQ, the NASDAQ 100 ETF, can drive the ETF, this whole index, higher significantly, or it can create a pullback. But given the technical picture that we're seeing here, by now you guys have to understand that clearly. This is again, a minor bull flag. This bull flag looked like this. This one, watch. This one looked like this. What does it look like? It basically was, it pulled back a little bit, but it was still pointing higher. So it would be something, it was going like this. Okay, so you can see that. 1 second. That's what it was doing. That's what it's doing all the way through. So these two components are going to be a major force this week, starting off on Monday. I want to make sure Google's on, yeah, Monday thing. Now, remember one thing. Look what Facebook did. We were long Facebook on a 2-to-1 long bias. That means we had double the money betting on the long side. Um, for every $2, we bet $1 on the short side, and Facebook went berserk. So any of all of you who participated in it, well, you know how good you felt. All right. So keep in mind that Google is the direct complement of Facebook, digital advertising, all that good stuff, and the key is Google should deliver some stellar numbers given what Facebook did. And remember, nobody really liked Facebook. So I'm not talking about the company itself, but nobody liked Facebook as a stock, like a blah, blah, blah. And look what it did. All right. So Google should follow that. Google should follow Facebook's trajectory. And we will look at that chart before we end the session tonight. And we've been doing very well in Google overall. So it's fine. So saying all that, this is a very powerful chart going all the way back to 2018, May, right here. This is what we are. You don't need to be a rocket scientist to figure out, and I'm going to draw another line here, a rocket scientist to figure out that this is a uptrending channel. There we go. Wow, it can go as high as 200. That's a lot. And those cheap calls that we buy at 50 cents, 60 cents, 90 cents, a dollar, $1.20, those deliver and have been delivering 70%, 100%, 200%, that type of move. For swing traders who are looking ahead and say, I don't really care about, for swing traders who think like that, and we have many traders like that, who say, okay, I'm going to buy it a month out, not the weekly calls, and I'm going to just sit there and we'll let it happen as long as this channel stays intact. Well, they get paid the big bucks. So you can see that very clearly. Now that's your NASDAQ. This includes techs and biotechs. So it's a very, very powerful breakout, and we're good. Now, the one that hasn't caught up yet, and this is what we like. I love playing the ones which are the laggards. Everyone likes the comeback kid, right? Tiger Woods. So many other, so many other things in our life. We love comeback hits. We like things which keep on getting hit, and then they get up and they say, I'm going to keep doing it. Well, that is the Russell 2000. That's your IWM. This is made in USA. This is the company. These are the companies. Lots of small cap companies on the energy side, biotech side, home building side, sectors, which basically companies which are in the Russell 2000. You can always Google Russell 2000 and say, okay, and look to see what's in the Russell 2000. Remember, it is the one of the largest, aside from the Wilshire 2000, basket of companies. There are 2,000 companies in the S&P 500. There's only 500 companies. On the NASDAQ 100, there's only 100 big companies, right? So on the Dow Jones Industrial Average, it's only 30 companies. So in this particular case, on the Russell 2000, the IWMs, which have been a perennial favorite of ours for years and years, I kind of moved away from it in the last couple of months. Now I'm back into it. I'm focusing into it. I think this one is going to be a major comeback kid. It has been. Their calls are damn cheap, and I think it happens because the U.S. economy, thanks to the very friendly business administration policies from the Trump administration, the U.S. economy is humming along. Don't believe all the garbage that you hear out there. Okay? Of course, we have a lot of work to do, but at the same time, the U.S. economy, in my opinion, invests in the United States of America. That's the way I look at it. Not because I'm being a patriotic, jingoistic, trader, Frank, as you know, but from the standpoint of where we are on the U.S. economic basis, the Russell 2000, in my opinion, is the comeback kid. Could be dead wrong, but who cares? Because the fact is, it's my opinion based on a lot of observations, both fundamental and technical. So if you look at the Russell 2000 here, this was the big top right there. Let me make that line a little bit thicker. There are 2,000 companies in this basket. Remember, not 500, not 100, not 30, 2,000. So your risk is very well diversified when you're buying a basket of 2,000 U.S. based companies. So based on that, this was a major high on the Russell 2000 back on February 25th. We can actually move that down here, somewhere in that range, which was approximately at around 159. Keep in mind, we are playing the 159 calls on a week by week basis, right? So saying all that, they were the strongest mover on the Russell 2000 was up almost 1% versus 0.47% on Friday. The Russell 2000, the IWM, was up 0.97%. The QQQs, I don't have the exact number in front of me, were up. One second here. How much were they up? I don't have that directly in front of me on my other screen, but let me compare this directly with the S&P 500. S&P 500 was up, and I'm rounding off the numbers, roughly 0.5% on Friday on that big sharp move higher. And let me remind everybody, when the markets opened down way lower on Friday, I tactically looked at all my charts, looked to see all the oversold conditions, everything. I said, buy. Guess what the market did? Closed at the highs. That is invaluable money-making opportunity because you all are members of Clueless A Trading. The only thing you all have to do is act on it. Think about it. The market's opened down, pretty crappy. Turned around, didn't go up in a straight line, zigzagged its way up. I showed you all through the day what it was doing, what it was going to do, and that's exactly what it did. But unless you act, like you say, you can take a horse to the watering hole, you can't make it drink. It's like one of my little adopted dogs. You can't make it drink. So I give it some water, I put some water directly, so he drinks. But he doesn't drink directly off the thing. And these are rescue dogs, so maybe he had some issue way back where, some sort of event where he doesn't like drinking from a bowl. So you can take a horse to the watering hole, you can't make it drink. So I can't make you guys drink water. Okay? You guys got to do it. You guys got to be thirsty enough to go to the watering hole and drink and follow the roadmap that I'm showing you. So saying all that, this one has nice room to move to 159, 161, and the upper end of the rising wedge, as you can see here, is 163. Can it happen? Yes, it can. Technically, it can certainly happen. There is nothing here, and this is why I call it the comeback kid, because it has catch-up to do. And that catch-up, not ketchup, but catch-up, is this portion here. Because the other ones, the NASDAQ, as I showed you, has broken out. The S&P 500 is breaking out, and this one has not broken out yet. Yet those candles are powerful. Those are billions of dollars that are coming in. So this one, in my opinion, is the comeback kid, the Russell 2000 IWM, and it's going to play catch up. Generally, what I've seen over the many years that I've been trading and observing the market since my days on Wall Street, where, by the way, I was not a trader. I used to trade on my side, on the side, but I was more on the analytical research and sales end. Okay, so the brain stuff. But so I will tell you what I've observed is that by the time the Russell 2000 catches up, the market basically is fully short-term or intermediate-term overbought. You both understood what I just said?
Yes.
So by the time the Russell 2000 catches up to these levels, I would say, I mean, that's asking a lot for it to go to 164, but still, then the markets basically are technically very overbought, which we know by now in simple English means they're going to fall hard. So this is powerful. Now this the green arrow that you all see right here generated is not by me. That's an automatic buy signal generated by Thinkorswim algos. It's interesting. I look at it. I don't give it that much credence, but it's good. It's good to see. Right there. Right there. That one. So, so that's your picture on the broader indices. This is your DIA, or the Dow Jones Industrial Average Diamonds. This one, as you know, comes under severe pressure certain times of the day because of the big industrials reporting earnings. Boeing has been overall good to us on a tactical basis, but keep in mind that stock is way off the highs. So when Boeing, and there was a piece of negative news, New York Times reporting that Boeing did not turn on the safety feature on the 737s before they sold a bunch of fleet to Southwest Airlines. Now that might hit Boeing tomorrow morning. So Boeing and all these things are part of the Dow Jones Industrial Average. We know that. Look what happened to a couple of the other companies which fell apart on the Dow Jones Industrial Average because of earnings. So 3M, for example, what a drop! My God, as if they're all going out of business. But hey, that's how the market reacts, and the machines react. So those things affect the Dow Jones Industrial Average. So just keep in mind that even though the overall trend is higher, we do incur some severe volatility because these big industrials, some of them go through the roof, like Northrop Grumman, and things like that. And Norfolk Southern went through the roof, but Northrop Grumman did phenomenally well for us. So those type of things, and Boeing then, on good news, because they're fixing the problem. They're just moving along, moving up $6, $7, $8 from the bottom, and those my charts on an intraday basis constantly show that. Those are great trading vehicles, But keep in mind that they do create volatility during the day when these big industrials deliver their earnings, and then if they flop lower, so there's a slightly different dynamic. So let me draw two lines here in front of you so you all can see. And before I go any further, are you both with me so far? Am I explaining things on a simple manner so that everyone can understand?
Yes.
Okay, that sounds good.
Yes, yes.
So I'm going to draw the rising wedge here. I picked the bottom right before Christmas. Two major lines of contact. Watch this. Change this color. There we go. Right? Bouncing off this red line here, the 50-day moving average. Now we're going to draw the upper end of the rising wedge. Watch this. We pick a point here. You can pick this point. You can pick this point. You don't want to pick that point because that is more of a flat top, what we call an ascending triangle. Okay? So that one we're going to draw like this. Oops, sorry. Actually, this was. So I'm going to pick this point here, right there. The markets broke down on the 7th of December. Touch this right there where the markets peaked on the 25th of February. Extend to the right. Change the color. All this, by the way, people who are serious about understanding and managing their monies on their own, and we're always here to help, you all need to sign up for the advanced coaching sessions because I'll walk you through how to construct. Chart construction and trade management go hand in hand. Understanding charts go hand in hand. So let me just do this. Hold on. Perfect. So upper end of the Dow Jones Industrial Average, where the Dow Jones Industrial Average peaked back on the 3rd of October 2018, right there, is up here at 269.46. That's on the DIA. On the actual Dow Jones Industrial Average, the high was 26,951. So pretty much here, 26,951. Yeah, right there. Okay. So we still have room to move. we still have room to move. This is still a bull flag, but we have slipped out of this rising wedge, as you can see. And that is primarily because of the reasons I explained in the last 15 minutes regarding the large industrial companies that are reporting numbers. A lot of them sell 70% of their finest US made products to world consumers, global consumers, and because of the US China trade tariffs and other global slowdown here and there, some of those consumers have slowing down their purchases. Remember, we are the world's finest makers of some of the finest components, high-tech pharmaceuticals, industrials primarily, and they are our consumers. So if those consumers slow down, obviously, you're going to see a slowdown in earnings for some of these companies. FedEx mentioned that on their conference call, and these are things too. Obviously, these are things that need to be solved, and that's part of the U.S.-China trade deal is going to solve and mitigate a lot of the fears that are hanging over the market, and the industrials will fly. In that case, the Dow Jones Industrial Average can hit that all-time high that it hit on October 3rd, 2018. Technically speaking, it looks like it wants to go there. So let's see what happens. So now we're going to jump into what happens on a daily basis. Okay, so this is your, I'm going to pull down one of my saved charts. And we're going to look at the E-mini, there are two Fibonacci charts that I have. So this one, for example, okay? So this is your Fibonacci retracement. Going back to a reference point of 23rd of April. Let me expand it. There you go. As you know, you've seen this chart quite a few times, so I'm going to walk you guys through it. For any trader, if they trade these charts just based on the levels and the arrows, they have a very high probability of making money. I take the time and energy to keep on showing these arrows because these are the arrows where the algos are coming to buy or sell. And you guys know that by now, okay? For people who don't need the assistance of arrows, red arrows and blue arrows or green arrows, whatever, in my case, mostly blue arrows I show, you can just simply look at the levels. This was 100%, I'm sorry, there we go. 1 means 100% Fibonacci retracement all the way up there. This is your 50% line in broad, in thick, dotted blue. And the 50% Fibonacci line, as I explained earlier on in this session, is a very powerful support. You can clearly see that how many times we have tested, slipped below the 50% Fibonacci level, moved down to the 38.2, which is this one. Remember, I don't create these levels. These are automatically generated once you place the Fibonacci retracements over any chart. And you can clearly see here, we even tested the 23% Fibonacci level back on the 25th of this month, last week. But this one kept on getting hit, slipping and sliding, but it held. So the 50% Fibonacci is a very powerful level. We have to, and I don't care if you care about numbers or not, but just look at it visually. If we break well below if we break this and don't manage to come above this dotted line, which is the 50 Fib 50 as we call it, then you want to remain short the market in the form of SPY puts. It's really as simple as that, guys. But every time it slips below, this happened at 9:45 on the 26th, which was Friday. So let's look at Friday. What happened? Very important. So Friday, the market's open. This is the 26th. Change the color. This is the 26th Friday. This is all pre-market while you're sleeping and having, dreaming big things. 6 o'clock in the morning, 9 o'clock in the morning, right there. Market's moving up nicely till 9. Then comes a very powerful move, 3 candles down. By that time, it is 9:45. This is 9:45, 15 minutes after the market started. Everyone's freaking out. We actually slipped below that. You can see this tail. We slipped below this megaphone, this line here. We tested the 38.2 fib. Everyone's freaking out. We are looking at it carefully. We're not putting out shorts out there because of I'm seeing major oversold conditions. There is no guarantee the market's going to bounce, but I didn't really see any reason for a massive drop. And the reasons behind that drop are all, and I'm not going to say it for a purpose because it's all on the Twitter feed. You all can go see what I wrote. What were the real reasons for the drop? Written in plain English. Markets turn around, hammer reversal at 9:45. Big move up. Pulls back a little bit, profit taking, big move up. At 11 o'clock, then a consolidation. This is what happens in the reality of the business every single day. Then a consolidation. How long does that consolidation last? It lasts from 11:45 to 1:30. For people just looking at prices and I always keep on saying that it's like a broken record like 900 times. They are lost. They're just looking at the prices like, oh my God, this is it. It's the end of the world. All kinds of stuff. But we are looking at charts. And that chart clearly showed that this move that started pre-market, 15 minutes after the market, this is what is this pattern called? Again, a bull flag. You can call it a cup and handle. Cup, handle. A sharp cup, but a handle. Look at that. So what happens when you have a cup and handle? Majority of the time. Starting around 1:45, 2 o'clock, the market breaks out. Monster breakout over the upper range. Monster breakout over the upper range. This was your upper range. Right there. Now this is Fibonacci 101, which is 100% retracement. That means we have completed the pattern. I have also talked about the Fibonacci extension, how much something can go if it just breaks out like crazy. The extension on the Fibonacci is this big fat blue line right there. Now I'm giving you a slice of what I teach in detail and much more on the advanced coaching sessions, the ACS sessions. So anybody who wants to further their career in trading, I highly suggest that you sign up. And that is a straight talk coming out of me. Mike, can you mute your microphone for a minute, please?
Okay.
Yeah, try to do that because we're getting a lot of feedback here. Okay.
Okay.
Now, the Fibonacci retrace extension is 1.61. Remember, you don't need to be a rocket scientist to figure it out. Let the chart show you. That shows as 29.58 on the E-minis. Didn't I show that to you on the earlier charts when I was showing you on the daily where we can go? That's exactly the case. Do you think we can get there by early this week? And whoa, we have a Fed meeting coming out this week. Whoa, Wednesday. Got to check that out. Of course we can get there before Wednesday. It's only 14 points from here. 14 times 5, 6, yeah, about 100, 220 points. Didn't I mention the same numbers earlier on when I was explaining the S&P charts and the E-mini charts? Absolutely. Math doesn't bullshit. Traders do. Okay? Math is 1 + 1 = 2. Markets don't always equal 1 + 1 = 2. But if you look at the chart, they're very mathematical, very direct. What does it mean? It simply means you make more money. That's all it means, because this game is about making money. It's not about being a mathematician. It's about making money. So if you figure these out, you will see that this is in play. This zone is in play. That's about, like I said, 14 S&P points. So roughly about 100 to 110 Dow points. And it reaches a major extension. That means the market is super extended at this level. So the more you focus on this stuff, it is not hard. Honestly speaking, a half smart kid don't even have to be that smart because I'm not that smart. Trust me. Okay, a half more smart kid can look at these charts, get some tutoring on how to read this, and trade the market. It's a fact, and all of you can do that. So don't overcomplicate this matter. Overcomplication comes because of the volatility that incurs like that. That's the reason why you need to take that extra step forward, learn to trade, as I put on the hashtag, and not freak out. The trend is higher. So let me draw this line here. Bear with me. And let me help. I mean, my job is to basically draw these lines and show you the roadmap. Your job is to understand it and follow it. If we do that, this is the zone that we could fall into right there. Right there. And that's a decent 70 to 150% on your SPY calls. So if somebody came to you and said, here's the roadmap here, and we do this every week, every month, or sometimes every day, that we're going to give you 150% on your money on that amount of capital that you're putting out on that particular trade, and you don't do it, well, you tell me how stupid that is. And that is pretty much what's going on across the board, not just with some members, but that is pretty much what's going on, Mike, with the rest of the market. Look at the guys on the media. They're all like, oh my God, it's all going to crash. Everything's going to crash. I mean, God damn it. Intel was down $5 and the market still went higher. You couldn't even imagine that, because the reason behind that is there are so many other great companies that are moving higher, like the Qualcomms of the world and Microsoft and this and that the market basically soaked up that drop and ran with the winners. So coming back to it is literally every single week, every single month, we are showing you, and sometimes every single day, big winning trades across the board. Not just saying it and going away, showing that every day on the real-time Twitter feed. Giving levels where we are taking our profits. Sometimes just letting them go higher. And showing you the bigger picture where the road is going. If you guys, or some of you, are not doing it, then, like I said, the horse is going to the watering hole. The horse needs to go to a mental institution. All right. And the last I checked, my son used to be a mini equestrian. I can never say that word. When he was young, he was good. He was good. I still love his riding pictures and stuff. You know, he never went to the competitions and stuff, but great. You know, out here in Jersey, gorgeous places. And I'll tell you, if those horses were mental, my son would have a lot of broken legs, you know. So we gotta really get our heads straight here, and that includes me sometimes. All right. So the point is that some of you just got to get up on that horse, okay, please, because this market is a horse like running. And yes, sometimes it screeches and we fall off, you know, like, oh my God, what the hell happened? Well, the horse probably stepped on a little rock, you know, and thought the rock was the mountain, you know. So I don't know, you know, but the fact is that we can fall off the horse here and there, but the horse is moving forward. And you can see that clearly. So pretty major technical breakout here. And unless we fall, I repeat, keep it real simple. Like they say, the KISS principle, keep it simple, stupid, K-I.S.S, is unless we break below this 50 fib, which is around 29.24, write that down somewhere on the E-mini futures, okay, roughly around 29.20, 29.25 on the S&P 500, and consistently remains down, the market is going higher. And that's really what it is. Now, these type of drops, when they happen and it keeps on retesting the Fibonacci 50 level right there, are not pleasant. I know that. It's not pleasant for me either. But hey, you know, we want like everything to be fair and real pleasant and cushy. Then don't be a trader. Don't be an investor. You know, go sit on a fat boy couch, grab a beer, not make 100, 150% of your money, and just be happy. Well, that's not my goal. Okay, I'd like to drink a beer after a long day's work. Have a nice chill beer, which I do, and then I feel good. So, but not in the middle of my trading. So, saying all that, this is where we are. Okay, ladies and gentlemen, sir, sirs, Mike and Mike. So it looks good. Looks good. Not super bullish, but it looks very good. Now, in between, you could get some slipping and sliding. I'm starting to guide people as much as I do every single day. But unless we see slipping and sliding, which consistently stays below this big dotted line, we are okay to go. Now, that's it. Now, this is a triangle breakout. You can see that it was trading within this megaphone triangle, and it kind of did this, and then bang, it went down. This is so and it's a range. It's a range. This is the second part of the way you look at it. This is your range, 29.13, which I even post during the day and early in the market, 29.41 and 29.13. Big red line. Okay, you guys see that? So that's 28 points. That's this level is 28 points. So if you add 28 to if you add 28 to 29.41, which is the upper end of the range, remember this is 28 points. So you add 28 points to it. Let's do the magic. So we add 28 to 29.41 to be exact. We are at 29.69. So where is that on the charts? Right there. See? See how methodical this is? This upward channel, once it enters it, there's a good chance that the market would end this cycle of the run somewhere in this 2970 zone. That's the real watering hole. All right? So on the way, let's gallop up there as long as the technicals stay firm. Remember, this level here, range is 28 points. Add 28 to this, no rocket science. It adds up, it gets here. In the meantime, the Fibonacci extension at 2958 is where it's going to hit a roadblock also. So, what's the best way to make money? If you want the simplest way to make money, and that's how we're going to end this call, okay? And I might do a session tomorrow too, right after, well, tomorrow's Google's earnings. Yeah, after Google's earnings, just to see, what the markets are. So, let's keep it simple. You want to play the simplest way you play the markets, play the indices. The SPY, forget individual stocks. I'm just saying, don't forget it. I'm just giving it a simpler way. SPY, QQQ, which is the high growth monsters. That means highly volatile monsters too. IWM, which is, I call it the comeback kid, made in USA. Okay. I call it made in USA. How about that? That's like Make America Great, except made in USA. Okay. And you can always play the Dow Jones Industrial Average, the DIA. If somebody says pick the best to the worst, no, I'm not going to, because this has the highest potential. This is I would say this would be this one is the fastest growth mover, because the fastest growing component of the US economy is technology. We rule in technology. Nobody does better than us in technology. Even the Chinese stole all those patents and stuff, and they're damn good at what they do. And now they're negotiating I think we're going to level the tech playing field. So there we are. Just play the SPYs, play the IWM, play the Qs. Forget about individual. And I'm not suggesting, I'm not your advisor, I'm not your broker, I'm not your mommy, I'm not your daddy, I'm not your grandpa, I'm not your sugar daddy or sugar mommy, okay? I'm just somebody who's basically suggesting things which are highly effective, which have worked very well, which are working very well despite the most difficult markets. So you guys decide what you want to do. Whether you want to get to that watering hole or whether you want to trip over every little pebble and fall apart, that's your problem, not mine. So, saying all that, the fact is that play the clean indices. The difference between this and playing individual stocks are individual stocks have individual stock risk. You could have a great chart and all of a sudden one piece of bad news hits the tape on that particular company and the stock goes down. Yeah, it might turn around 2 days later and start running up. Look at United Healthcare. Look at some of our biggest winners, Humana. Look at Anthem. Mr. Bernie Sanders, aka Mr. Socialist, candidate, decides that everything is going to be free Medicare, which is a great thought, sure, but it doesn't work like that. And everything is free. School's free, like everything's free. Great. Okay, these are good, noble ideas, but who's going to pay for it? So the point is that the United Healthcare, the Humanas, and the Anthem Healthcare insurance, Anthem, the insurance company, finest insurance companies in America, they all fall. We started buying them. It's all there on the Twitter feed. And look what they are now. They're up 10, 15% on a lot. And the options are up anywhere from 150 to 340% plus. So those are individual stock risk. Those are they give you a bigger reward, but you need to be cognizant of that. It might get hit with these tape bombs, which are basically negative news flow that can hit them. But in the meantime, you want to play it clean. Market's going higher. Well, SPYs are going to go higher. Nasdaq's going higher. The QQQ is going to go higher. The Russell 2000 is going higher. All IWM is going to go higher. You don't have individual stock risk. So, gentlemen, I think we covered a lot of simple but very effective points how to play not just earnings, but this overall market. Stay focused, and let's just do it. We have a couple of more weeks of earnings left over going into the first part of May. There's going to be great companies. Buying the baskets like I do pay off very well. They are tricky, but overall they work out very well. That one that you lose, the other one basically gives you a triple or a quadruple on those cheap options, sometimes not that cheap. So you make up a lot more than what you lost on that one that didn't work out on the earnings. That's another way of doing it. For exact details, specifics, strategy ideas on how to set these things up, sign up for the advanced coaching sessions. And that's the only way I can help people. So on that note, thank you for attending. This is going to go up on YouTube in the next 15 to 20 minutes. God bless you all. Mike, you're a great guy. Talk to me sometime this week. I want to work with you a little bit more. Mike H., you stay well. And anyone else out there who needs any type of help other than diapers, which I will not provide, reach out to me. We're all in the same boat. This is Kulusay Trading signing off for tonight. God bless you all.
Thank you, Frank.
Yes,
Frank,
thank you. Thank you.